Imagine waking up one morning and discovering that the money you've been saving your entire life isn't actually yours. Your bank account still shows a balance. The app still displays the same numbers. Nothing seems wrong until you try to withdraw it. We're sorry, sir, but you no longer have the legal right to demand your funds. A nightmare, right? But what if I told you this isn't fiction? This exact scenario has already happened in multiple countries around the world. And the legal framework that makes it possible already exists in most modern banking systems, including the one you rely on every single day. Today, we're diving into the hidden law, the quiet reform, the unnoticed line of legislation that effectively turned your savings from your money into the bank's property. Every time you open a bank account, you sign a stack of documents, agreements, terms and conditions, deposit forms, privacy notices. Most people sign without reading a single word. Inside that legally binding stack of papers is the foundation of this story, a principle in modern banking known as deposit reclassification. When you deposit money into a bank, you're not placing it in a safe with your name on it. You're not even storing it there. Under modern banking law, especially after 2008, your deposit is legally reclassified as something completely different, a loan to the bank. In other words, once the money enters the banking system, it's no longer legally your property. You become an unsecured creditor, and the bank becomes the legal owner of your funds. You don't store money in a bank, you lend it to them. Most people have never realized this because banks never explain it. It's just quietly written in the fine print, wrapped in legal language nobody reads. But the implications, they're massive. Because once your money becomes the bank's property, the bank can legally decide what happens to it. And that's where the hidden law comes in. The 2008 financial crisis wasn't just a meltdown of mortgages and banks, it was something much bigger. The moment governments realized they could not keep bailing out banks forever. Before 2008, failing banks were rescued with taxpayer money, a bailout. But bailouts caused massive government debt, public anger, and political instability. So after the crisis, global regulators agreed on a new solution, bail-ins, and this is the silent law that changed everything. A bail-in is the opposite of a bailout. Instead of using taxpayer money to save a failing bank, the bank uses your deposits to save itself. Yes, your savings become the emergency fund. What made bail-ins possible? The legal reclassification we just talked about. Since your deposits are technically the bank's property, they can be used to cover losses during a crisis. And between 2012 and 2015, countries around the world passed the laws to make bail-ins official. The US with the Dodd-Frank Act, the European Union with the BRRD Directive, Canada, Australia, New Zealand, and dozens more. Most citizens never realized it happened. These laws didn't arrive with fanfare, no news headlines, no public education campaigns. They were slipped quietly into financial reform packages nobody read. But the effect was massive. Every depositor in the modern banking system became a potential funding source for struggling banks. If you want to see how this hidden law works in real life, look at Cyprus in 2013. On a normal Saturday morning, millions of Cypriots woke up to a nightmare. ATMs stopped working. Bank doors were shut. Accounts were frozen. When the banks reopened, every depositor with more than 100,000 euros lost up to 60% of their savings overnight. No warning, no appeal, no refunds. Those funds were automatically converted into bank shares, which quickly became worthless. Why? Because the new laws allowed the government and central bank to perform the world's first major bail-in. In that moment, the world witnessed the truth. Deposits are not your money. In a crisis, they become a tool to rescue the bank, and depositors are legally unsecured creditors, the lowest priority. This shocked Europe. Governments insisted it was a one-time emergency. But behind the scenes, it became the template for every major economy. Now, the bail-in framework is global, including in the banking system you use every day. So why don't they want you to know this? If banks or governments openly admitted, your savings aren't legally yours, they're the bank's property, and in a crisis we can seize them, there would be chaos. Bank runs, public fear, capital flight, and economic instability. So instead, they explain it in academic language, like loss-absorbing capital instruments, unsecured creditor hierarchy, or resolution mechanisms. It sounds harmless. But the reality is very simple. The modern banking system is built on confidence, not cash. If people lose trust, the system collapses. So the law stays hidden in technical language understood only by lawyers, regulators, and financial insiders. Yet the risk is real and growing. Let's test a fact most people don't know. If every customer of your bank tried to withdraw their money at the same time, your bank would collapse within hours. Not because of panic or corruption, but because banks do not hold your deposits. They lend them out the moment you deposit them. This is called fractional reserve banking. Depending on the country, banks hold as little as 0 to 10% of deposits in liquid cash. In the US, the reserve requirement is currently 0%, meaning your bank does not need to keep a single dollar of your deposit in the vault. Every withdrawal depends on loans being repaid, markets being stable, other people not withdrawing, and the central bank supporting the system. This is why the hidden bail-in law exists. If a bank collapses and the government refuses a bailout, the only remaining source of money is you, the depositor. So, who gets paid first when a bank fails? Under the new global rules, the payout order is clear. At the top are secured creditors, like bondholders and the government. Then preferred creditors, like institutions dealing in derivatives. Then the bank itself for its operational costs, then insured deposits. And you, the average depositor with uninsured funds, you're near the bottom of the priority list. That's why bail-ins target savings accounts, checking accounts, fixed deposits, and business accounts. The bank doesn't need your permission. The law already gives them the right. So what can you do? This video isn't meant to frighten you. It's meant to inform you, because no one else will. If you're watching this, you're already steps ahead of most people. Here's what financially educated people do. First, they don't keep all their money in one bank. Diversification reduces your exposure to one institution's failure. Second, know your country's deposit insurance limit. The FDIC in the US covers up to $250,000. But that's only if the insurance fund has enough money during a widespread crisis. Third, consider safer assets outside the banking system. Historically, wealthy families preserve wealth through precious metals, treasury bills, short-term government debt, well-chosen real estate, and diversified investments. Fourth, understand the difference between money and credit. Bank deposits are credit, not cash. Cash is what banks don't have. And fifth, monitor your bank's stability. Large banks are safer, but not invincible. The final warning: the hidden law isn't coming. It's not theoretical. It's not a conspiracy. It's not a prediction. It already exists. It has already been used. It will be used again. Our banking system quietly changed after 2008, and most people never noticed. Maybe your money is safe today. Maybe your bank is stable. Maybe your country has strong regulators. But financial crises don't ask for permission. And when a bank fails, it's not the government, not the shareholders, not the CEOs who take the hit. It's the depositors, the everyday people. People who thought their savings were safe because no one ever told them the truth. Now you know, your money in the bank, it's not really yours. It hasn't been for a long time, and the law that made it possible is already written. Thanks for watching. And if you found this information valuable, make sure to subscribe for more content that looks behind the curtain.